Hi everyone, good afternoon and welcome to this pre-Shell AGM briefing webinar being hosted by ACCR, the Australasian Centre for Corporate Responsibility. My name is Sarah Brewin. I'm a company strategist with ACCR covering Shell, BP, Glencore and Equinor, and I'll be moderating today's webinar. I'll kick us off with just a few very small housekeeping points before we get into content. So you would have heard that the webinar is being recorded and we'll be circulating a recording after the event for those who can't stay till the end, or for those of you who have colleagues who might have missed out on joining us. We have a Q&A function, and please feel free to put your questions in at any time and we'll aim to get to them at the end, or if it's something that we can handle over text, we'll respond in the moment. The content from this webinar will be drawing both from our research into Shell's LNG Outlook and LNG strategy, which we published last month, as well as our response to the Shell notice of meeting, which was released, last week, our response to their response to the LNG related resolution that we'll be speaking to came out yesterday, and we'll share links to both of those documents in the chat so you have those as resources. So with those boring bits out of the way, let me get into a brief overview of our agenda and our speakers. So we're really pleased to have Vaishnavi Ravishankar with us. She's the head of Stewardship at Brunel Pension Partnership, one of the institutional investor co-filers on the resolution that we'll be speaking about today. And she'll provide her perspective on Brunel's rationale for supporting the resolution and their engagement history with the company and what they're hoping to get out of this ongoing engagement around the company's LNG strategy. And then my colleague Nick Mazan and I will give a presentation that will look into ACCR's research into Shell's LNG portfolio, its demand assumptions, and the climate commitments that really underpins the resolution, which is on the ballot for next month's Shell AGM. So with that, let me turn to you, Vaish, and just ask a few short questions to kind of give us a bit of a sense of framing for the resolution, for the research that we'll be discussing today. So maybe firstly, if you could speak to why Shell is an important stock for Brunel and how this has shaped your longer term engagement with the company.
Great, thanks, Sarah. We've been engaging with Shell on a number of different topics, and specifically on its climate commitments for over 5 years. In the last couple of years, we've selected to escalate through co-filing shareholder resolutions, as we found the company's response to engagement quite underwhelming. As a lean team, we think about the benefits and costs of any escalation strategies carefully, but this is a company that continues to be one of the top contributors to our financed emissions, and the dialogue so far have continued to bring to question the credibility of their net zero targets.
Yeah, thank you. So maybe you could just spell out what some of your key concerns are around Shell's LNG strategy and why you saw taking that escalation step of filing a shareholder resolution as being necessary to help address some of those concerns.
I think our key concern is around how the company will actually meet its net zero target while expanding its LNG business significantly. As many would be aware, they retired their 2035 NCI target and adjusted their 2030 NCI target last year. No new targets have been proposed, so there's a question as to whether the company is really being straightforward about its position around climate issues. The filing came in the back of timely research from ACCR and intensive engagement with the company since November last year, which failed to give us any clarity or assurance. And given their LNG strategy is a substantial component of their growth strategy and is built on the basis of a very optimistic demand outlook, we are asking for more information on the basis for the assumptions embedded in the LNG demand outlook, which seems to be well above all IEA scenarios, including the STEP scenario, which yields a 2.4 degree warming, and how that demand is then reconciled with their broader strategy and climate commitments, particularly during the 2030 to 2050 period.
Thank you. And then lastly, what is it that you are hoping to achieve through the filing of the resolution and then the engagements that have come off the back of that?
So the focus is very much on transparency, so we can't be accused of being over prescriptive. There is plenty of room for the company to determine how it is going to respond to the asks, which we think are reasonable questions around what exactly is underpinning their strategy. We think the onus is on the company to strengthen their LNG strategy and disclose additional information that will then enable us to appraise the risks associated with the LNG portfolio and also determine the compatibility with their climate commitments. We remain open to engagement. We have a meeting coming up in May with the chair, but so far the company's response to our asks has not gotten us to rethink this particular resolution. They hold the view that all of the information we are after is already available publicly, but we are looking for the company to substantiate how the LNG business will remain competitive as renewables scale up, and we're likely to see downward pressures on pricing. They claim to be Paris aligned, but is that claim really credible? We need to resolve our understanding of how the life cycle emissions of the LNG business matches up with that trajectory. If the company believes that their climate ambitions are indeed untenable, we need to see further sort of modeling as well as narrative from the company around why and what steps they are taking to respond.
Great. Thank you so much, Faith. I think that's really excellent context setting for the presentation that we'll get into now, that will dig in further to the resolution itself and to the research that you pointed to that sort of underlies the resolution and sort of strengthens the rationale of this request for enhanced transparency. And so we'll start with the resolution text itself. If I could just have the next slide over. Thank you. So this is the text of the resolution. It was filed at the end of last year by Brunel together with ACCR, GMPF, Merseyside Pension Fund, and Share Action. And it's, I suppose, two things initially to say about the resolution. The first is that it has been filed as a special resolution, and if you have read the company's notice of meeting response to the resolution, you'll see that they've introduced some questions over whether this is a valid vehicle to have used. Our position is that we filed this as a special resolution in accordance with the Companies Act of the UK, in accordance with Shell's own Articles of Association, and this has been sort of accepted as validly filed by the company after their verification process, and there is actually no other process by which shareholders can compel enhanced disclosures from the company in order to improve transparency and facilitate the type of risk appraisal that we think is needed here. So that's the first kind of point around it being a special resolution. And then the second point, and an obvious one, I think one that Vaish has explained really articulately, is this is a disclosure-based resolution. So it's seeking enhanced disclosures from the company as to whether and how its demand forecast for LNG, its LNG production and sales targets, and its new capex into natural gas assets are consistent with its climate commitments. And being a disclosure a resolution, as Vaishya said, it's not trying to micromanage, it's not trying to prescribe very clearly exactly what types of disclosures would be needed to be made. It leaves discretion to the company in order, to allow them to fulfill the resolution ask as they see fit. But obviously the first question that comes to us when we put this in front of investors, which we've been doing intensively over the last month or so, and in the engagements that we've had with the company, both prior to and after the filing of the resolution, the question that comes to us is, well, what do you expect to see? What types of disclosures would fit the bill here? And over on the next slide is how we approach that question. And we do push back against the idea from the company that as the co-filers, we should be providing them some kind of checklist of disclosures that would meet the resolution ask. In our view, that would be an overly prescriptive approach. And so instead, we take the approach of putting out the questions that we think are currently unanswered and currently unanswerable on the basis of the disclosures currently in the market. And the questions that we think are really salient and relevant ones for investors who are trying to appraise the value at risk inherent in Shell's LNG strategy. And these questions sort of cut across three categories, and you'll see when we get into the research that these questions are really born out of a deep analysis and an inability to sort of grapple with the answers to these questions based on what's already out in the public domain. And this cuts across the sort of financial risk dimension, looks at demand assumptions, and also looks at the climate commitments of the company. So along the financial dimension, the sort of underlying key question that we think Shell needs to be answering is how it intends to protect long-term shareholder value in light of what we know is a sort of likely scenario of a supply glut coming on in the next 5 or so years, a related waning demand and appetite for longer term offtake agreements, and then ever increasing competition from renewables, especially in the price sensitive emerging markets that the company is really targeting as part of this LNG growth strategy. Along the dimension of demand assumptions, we're really asking ourselves why the company's demand outlook has been so unresponsive to some major shifts in global energy markets over the last 4 or so years that have led to permanent demand destruction, and how it's then taking a view on LNG demand that is so far above others, independent commentators, notably the IEA. And then finally, and really at the heart of the resolution ask, is how the company will be ensuring strategic consistency between its climate commitments and the goals of the Paris Agreement in light of its bullish growth strategy. So with that, let me just speak at a high level to what the strategy looks like before we get into some of the financial risks inherent in that strategy. And so here you can see on the screen on the left side are the company's LNG growth ambitions, and they've baked that into a number of targets around liquefaction capacity and growth in LNG sales. We've started to see increasing decision FIDs coming online that give effect to this growth ambition, and Nick will speak in a moment to this really significant FID of Argentina LNG. And we also see this LNG growth agenda baked into the company's remuneration policy. On the right side of the screen are the company's climate commitments, which we note, unlike some of their peers, they haven't dropped or walked away from. They are still holding on to their net zero by 2050 target, which they see as being aligned with the 1.5 degree temperature goal of the Paris Agreement. They have their 15 to 20% NCI reduction target. And increasingly, they're positioning their LNG growth strategy as being very much complementary to or congruent with their climate commitments, because they see LNG as having this central role in the energy transition, and in fact being Shell's primary contribution to the energy transition. And so really what we're trying to interrogate with this research and with this shareholder resolution is, how is the company squaring the two sides of this slide? On the left, their growth ambition, and on the right, their climate commitments. With that, let me hand over to Nick to talk to some of these financial risks inherent in the strategy.
Yeah, thank you, Sarah. And so here what we have done is a discounted cash flow model that looks at a Rystad base case, which is $12.9 per MMBTU, and models the returns associated with Shell's LNG portfolio under that scenario. Shell actually aren't transparent with the commodity price assumptions that they're using for the valuation of their assets, but based off of the fact that they're targeting Asian markets, we're using this Rystad base case, which was sort of somewhat representative of where JKM pricing is right now. We're comparing that in this analysis to a $5 price environment. That isn't us suggesting that we think LNG prices are going to fall to that level. But the sort of way in which we got there is that we've done a levelized cost of electricity analysis that looks at the cost of running a combined cycle gas turbine with LNG in many of the core markets that Shell is looking at. So China, India, Vietnam, Malaysia. And we've looked at the levelized cost of electricity of running that LNG to power plant and compared that to the construction of building new solar. And then we've adjusted the commodity price downwards to see at what price LNG would have to be competitive with renewables. We got to a range of $4 to $5, and so we chose the top end of that for this analysis to be a little bit conservative in terms of what is the potential impact to the value of Shell's LNG assets under that pricing environment. The IEA have done something quite similar in terms of their analysis and came at a range of $3 to $5 per BTU as well. So we're quite comfortable with that $4 to $5 range. And the reason that we're sort of looking at this comparison of sort of LNG to renewables is that the company talks a lot about coal to gas switching and the impact that lower prices will have in terms of stimulating more demand for LNG going forwards. And so for those two things to be true, I suppose you need to have a energy source that is going to be competitive with renewables. And so, and especially for baseload power, if you're going to see that sort of demand growth that Shell is projecting out to 2040, which is up to 718 million tons per annum, you don't really get there when you just think about this from a power perspective in terms of balancing the grid from an intermittency perspective. In our LCO and E analysis that we'll come to a little bit later, we do take into account the cost of storage as well. And even then, the sort of cost of running a combined cycle gas turbine in these countries is so much more expensive than building new solar and storage. And so how does gas compete at the bulk levels that Shell is projecting to get to this very bullish demand forecast that they're putting out? In terms of this discounted cash flow analysis, we came to a value of around $90 billion. You can see in the appendix of these slides that are online, this is a sort of abbreviated version of this, of sort of the breakdown of how we get to that figure. But it's seriously material. And this sort of answers one of those questions around why are we focusing on LNG specifically as quite a sort of maybe niche or specific thing to be focusing on through a resolution. But sort of that $90 billion represents well over half of the value of the integrated gas business, which is the largest business segment at Shell. And so from a materiality perspective, we think this is sort of highly material and the biggest risk that Shell is facing right now. As it relates to this sort of question around demand stimulation, there's this sort of narrative from the CEO that as prices fall, that sort of demand will be stimulated from some of these price sensitive markets that we're talking about here. We think there have been sort of some serious structural changes that have happened over the past few years through the impact on the reputation of LNG through this high commodity price environment over the past few years. And Sarah will touch on that a little bit later in terms of what have those structural changes been over the past 5 years and how has Shell been responding to that in their demand outlook as well. When you go to Shell and sort of raise this with them around what is that financial impact and what is this downside risk, because principally we're coming at this from the perspective is of Shell not having a good grasp of what is that potential downside risk or not appreciating the bear case associated with LNG in a sort of fulsome way. And that's what we're trying to present here. They'll point you to note 4. This is something that was mentioned in their notice of meeting response as well, of something that they point to as a sort of key part of their LNG disclosures, but also as something that they're looking to develop. They don't actually say sort of how they're going to develop that or what that's going to include. It could be that they're sort of planning on running a similar analysis to us. But in terms of the analysis that they're currently doing, and this is what we're looking at here, that what they do and what they present in note 4 is what is an impairment test. And they're looking at the difference between the book value and the residual value in that impairment test. And they come to a range of $21 to $27 billion. And so that's considerably lower than the sort of $90 billion that we get to. And the reason that is that they're not really taking into account the value of those assets, the value that they're expecting to create from those LNG assets going forwards, and then appreciating sort of the value destruction associated with a lower commodity price environment. And we think the way in which we approach this in terms of doing this discounted cash flow related to the LNG portfolio is a much more representative way of the potential downside risk and much more commensurate with the way in which buy-side investors think about the market capitalization of Shell and think about the risks that Shell is exposed to. On the next slide, we show the exposure Shell has to uncontracted LNG from 2025 through to 2050. And again, sort of this speaks to one of the questions as it relates to the resolution. So why are we focusing on Shell with this resolution on LNG? And when you look at this and you compare it to other independent oil and gas companies, Shell's uncontracted LNG position is around 1.4 billion tons of LNG through to 2050. You compare that to Exxon, who's the next biggest, or Total Energies after that, it's about twice that of any other independent oil and gas company. And so sort of the risk that Shell is taking on with this strategy is sort of much bigger than any other oil and gas company. And so they'll come back to us in the engagement and say, okay, so who should we look at in terms of good practice around good disclosure, or sort of who is sort of reassuring the market in a better way than we are. But I think this sort of doesn't look at that question in the right way, because the problem is that Shell has around 11% of the LNG market. They're the biggest independent trader of LNG, and they have this really big exposure to uncontracted LNG. And so as it relates to shareholder value, risk to shareholder value, the onus of responsibility is much more on Shell than any other company, and they're much more impacted by the future of LNG demand than any other oil and gas company as well. We've started to look at sort of what is the downside risk for Shell associated with falling LNG prices. And we modeled that for every dollar LNG prices fall, there's a potential $14 billion impact on the company's NPV. As an organization, we're not here to sort of try and project where LNG prices will go. But I think the thing to think about here is there's a huge amount of supply that's coming online in the next few years, probably starting at the end of this year through 2026 and 2027 as well. There's about an increase of 40 to 50% in total supply over that time period. That's going to put massive downward pressure on pricing. And we're probably going to see a general regime shift in terms of how LNG markets work, from being predominantly a seller's market due to the undersupply of LNG to predominantly a buyer's market. And so that pressure on pricing is going to have a significant impact on the returns for Shell. And we don't know where those prices will go. But when we look at sort of historical proxies where the market was more tilted towards buyers in the past, so pre-2020 essentially, and we look at sort of liquefaction utilization rates falling to like around the 90% figure, we saw LNG prices at a much lower rate, sort of sub the $10 per MMBTU range. And so sort of the point here being, we think that the price could move by well over $1 per MMBTU in the next sort of 5-ish years. When you talk about this supply glut coming, it's actually something that's mentioned quite comprehensively in Shell's demand outlook, LNG demand outlook from this year, which is surprising because I don't mention sort of Shell talking about things very comprehensively in their LNG outlook very much, but this is something that they do spend a bit of time on. And one thing that they say is that because of the poor project execution from the oil and gas industry, this supply glut that is being forecast by Bloomberg New Energy Finance, the International Energy Agency, even Total Energies, that's expected to come in the next couple of years, won't actually come until 2030 or beyond because of delays in the execution of project. I think that's quite sort of interesting and insightful, and actually probably quite historically accurate in terms of looking at past LNG projects and how they've been over budget and behind schedule as well. And so that could well be the case. I think the longer term implications of that are not good for a company like Shell, because those delays in LNG projects opens up more space for other technologies to compete and cannibalize the potential for LNG over the medium to long term. On this next slide, we look a little bit into more detail around what Shell's trading book looks like. There's quite a lot going on here, but the way I like to read it is from bottom to top. And so on the bottom, so below zero, you have the company's exposure to production and then purchasing agreements as well. And then on the top half, you have the company's sales agreements and then the size of their uncontracted position. That's the key thing to take away from this graph. The increase between 2025 to 2035 of the black bars there, that uncontracted position is 177%. So massive increase over the next decade or so. When we first produced this graph in sort of the end of Q3 last year, there was the difference between that and this graph. There were two. One is that sort of the size of these pre-FID projects, so the size of those shaded bars was much, much smaller. And now, because of, as Sarah already alluded to, the Argentina LNG acquisition, which is around 100 million tons of LNG, but a few other smaller acquisitions that took place in Q4 last year, the size of that pre-FID segment is much bigger now. And so shifts the conversation, or shifts our concerns from being one of how big is this current exposure and how big of a risk that could that be for Shell and its shareholders, to how much bigger could this exposure get if those projects are sanctioned in the next 5 years or so. And we would sort of probably expect that to be the case. As it relates to the company's contracting structure, you can see both the presence of oil index contracts and Henry Hub index contracts on both the sales and the purchase side. So there's a little bit of hedging that's taking place. But when you net those out, you see a net exposure to Henry Hub pricing on the purchasing side of things and a net exposure to oil index pricing on the sales side of things. And you can see the longer term of those Henry Hub pricings going out to 2050 on the purchasing side of things. I suppose one thing to comment here, we've seen sort of quite a lot of volatility in terms of Henry Hub pricing over the last few months, going all the way up to sort of $5. As liquefaction capacity in the US increases, we'd expect that to push up prices. And we saw sort of big price movements over the last couple of days, actually, in terms of Henry Hub prices going up. And that will sort of inevitably have a negative impact on the margins for Shell because of this net exposure to Henry Hub pricing on their purchasing agreements. They are the biggest off-taker of Henry Hub contracts out of the US. And similarly, and conversely, I suppose, on the sales side of things, as oil prices decrease, and again, we're witnessing that at the moment due to political action in the US predominantly, that'll put sort of downward pressure on the margins associated with their sales agreements as well. What you'll hear back from the company when you show them this, or sort of when you engage with them around their contracting strategy, is that sort of this is just how the LNG market works. So you sign 10-year contracts, you sign 15-year contracts, and those will roll forwards. And so the expiration of contracts in 2035 isn't an issue, and there'll be new contracts for beyond 2035, 2036, 2037 as time goes forwards. I think that's sort of a fair piece of pushback to some degree. I think we will see this to some degree, a larger presence of contracts going forwards. However, I think it's also important to think about the changing macro environment as well. And as we see this increased supply, mainly from the US and Qatar, we're going to see more competition on the supply side, more pressure on pricing. And so to look at the past sort of 4 or 5 years and to say, in that sort of LNG regime, we were able to get these contracts, and we're able to get those contracts in a similar way in the next 5 years. I don't think that takes into account those changing market dynamics and how much more difficult it will be for Shell to sign similar contracts for similar tenures as well. If you take a region like Europe, for example, and you think about the utilities there, the pressure that they're under, both from a regulatory perspective, but also from an energy transition and shareholder perspective, none of those utilities really want to be signing contracts through to 2040 right now because of that massive uncertainty and because of the declining year-on-year gas demand from Europe and the increased presence of renewables in the region as well. I think that's demonstrative of sort of how much more difficult this will be. And some of these price-sensitive countries as well, like Bangladesh and Pakistan as well, are also just sort of waiting in the wings for the prices to fall and for that negotiating power to increase over time as well. Next, we're going to talk about the cost competitive of Shell's underproduction LNG portfolio. This was also something that was that appeared to some degree in the company's notice of meeting that came out at the end of last week. And one of the commitments that the company made in that was to present the cost competitiveness of their assets compared to peers. This was something that they seem to sort of speak to a little bit in the capital markets day disclosures, and you can see this graph here is taken from their capital markets day presentation at the end of March. When you look at this, and this is it looks a little bit like a supply cost curve. It looks really good for Shell. Everything's sitting at the bottom end of the cost curve. You can see 17 projects here, and they're all much more competitive than many of their peers' projects. The problem with this is that of those 17 projects, 12 of them are backfills. And so what Shell is doing here is comparing the cost of part of a project to the full greenfield capex of their peers. And so when you're comparing the cost of part of a project to the full capex of an LNG project, then undoubtedly that cost of a part of a project is going to be cheaper. One of the other issues we have with this is that all of these bars are the same width. And normally when you do a supply cost curve, you look at the width of those bars to show the capacity or the equity share associated with the production there. And all of these sort of are not representative of that. And when we remodeled this, what you tend to see is that at the bottom end of the cost curve, you see Shell has smaller positions, and at the higher end of the cost curve, you see they have larger positions. The other thing that they've done here is included the average delivery cost from US Gulf exports. We're not sure why that they're using this benchmark, but it also overlooks the fact that, sort of, as I mentioned earlier, Shell is the biggest off-taker of US LNG as well. And so we don't, and sort of the contracts that they're signing sit above this line as well. So what we've done is remodeled this and put it sort of in a more representative way. So we've stripped out those backfills and only focused on the projects that sort of are representative in terms of the full greenfield capex that's required. And then we've brought in Shell's equity share there. And so broken out Shell's position relative to the rest of those projects, and then sort of included those in the yellow bars here. So you can see on the very left-hand side, we all know that Qatari gas is some of the cheapest gas in the world, the lowest break-even costs in the world related to the LNG production. And you can see Qatar gas trains 8 to 11. Shell has a 6.25% position. And the returns that they're getting from those projects are very, very low as well. It was very interesting. We were at the AGM last year and we questioned the reduction in the company's hurdle rates at the 2023 Capital Markets Day, going down to 11% for their integrated gas business. And the reason that they did that was to fit in these Qatari LNG projects. From a principal perspective, we don't think that's how the company should be thinking about their investment framework. But just to say that even though these projects are very low on the cost curve, the returns that Shell gets from these assets are not very good. But Qatar does represent some of the best assets that Shell has exposure to. Conversely, when you look further up that cost curve, LNG Canada, Shell has a 40% position in. It's a $40 billion project. And that sits very high up the cost curve, well above the global average. And Shell has sort of a really big position there. We've also included Shell's Henry Hub offtake position. Again, you can see here the capacity of those average contracts is much bigger than all of the projects that they have under construction. And the average price of those contracts is pretty expensive as well. And so when we take this all into account and we look at this in a more sort of objective manner, we can see that maybe Shell's under construction projects are a little bit more competitive than peers. But in general, the picture is not as rosy as Shell seem to be presenting at in their Capital Markets Day disclosures. And so I suppose this fits into a broader concern that we have around Shell's presentation of information in the presentation that we put out in November 2024. We also raised and also found a few issues with the company appearing to misrepresent International Energy Agency data and data from a independent academic organization as well. And so there's a little bit of a pattern here, and there's sort of speaking to this bullish demand forecast and sort of bullish strategy that the company has as well. With that, I'll pass back to Sarah to talk about this bullish demand forecast that I mentioned.
Thanks, Nick. So what you're looking at here on the screen is Shell's LNG demand forecast charted against the three IEA scenarios. And so what you can see at the very top of the graph here is the 2025 outlook in that blue range, and then the dotted purple line below that is their 2024 LNG outlook. And so that top blue line at the top of the blue range goes up to the 718 million tons per annum figure that Nick mentioned, which sits at 21% above the IEA STEP scenario, 96% above the APS, and 310% above the NZE. Look, obviously, we're at a moment in time where there is a lot of reasonable debate about the viability of the NZE and whether we're on a net zero pathway. There's even some legitimate concerns around the feasibility of the APS. But in our view, to sit at a level of LNG demand which is 21% higher than STEPS is a really concerning position to be taking, and one that needs to be really thoroughly substantiated by the company. So maybe just to sort of break into some of the implications of what it means to sit 21% above a scenario like STEPS. So STEPS, as we know, is a 2.4-degree warming scenario. And it's also one that assumes a business as usual case in terms of policy implementation. So it assumes that out to 2050, there'll be no further emissions reductions policy implemented. And we just don't think that this is a really plausible scenario, even in current political conditions. And not only that, but to reach a level of demand that's 21% above STEPS, you'd have to have not only no further policy implementation, but you'd have to have the world's governments substantially and kind of systematically regressing on their climate policies and their emissions reductions policies. Either there'd be this wide-scale regression, or existing policies would simply fail in their objectives. And again, we don't see this to be a likely scenario, and given its unlikeliness, we think that that imposes a higher degree or a higher burden on the company to explain this. We have sought that explanation directly from the company in our engagements, and we've asked them how they justify the delta between the IEA STEPS and their own demand outlook for LNG. The response that we've gotten from them is that STEPS has a lot of good news baked into it and it's unrealistic. And to justify that position, they've given us a handful of examples of policy regressions. For instance, the UK rolling back its ban on the sale of new gas boilers, Japan's having delays to nuclear restarts. So they've given a kind of piecemeal collection of case studies, which we don't think really gets them to this sort of wide-scale level of policy ambition being ratcheted down that would have to be achieved in order for this degree of LNG demand to be realised. So really, in our view, the company needs to do a lot more to explain this gap and justify how they see the net impact of all policy changes, seeing overall less rather than more climate action out to 2050. Just to stay on this slide for a moment longer, another kind of significant implication in our view of having a demand forecast that sits 21% above STEPS really relates to the question of physical risks. So we know STEPS is 2.4 degrees, so let's say 2.5 degrees if you're sitting 21% above that. What would a 2.5 degree world mean for the company's own demand forecast for LNG? We know, and we'll speak a bit more to the fact that they are hitching their growth wagon very heavily to the Asian economic growth story. And they see a lot of LNG demand coming out of that region. And we also know that this is a region that is particularly vulnerable to climate change. And so what 2.5 degrees of warming would do for economic growth in that region and in the globally is a question that we think the company needs to be answering. At a project level, we're already seeing some of the impacts of the current degree of warming on LNG assets. So, and we're seeing this kind of upstream and downstream. So last year there were cyclones in Bangladesh that lasted for 4 days and took offline some floating LNG import terminals for 4 months. A few weeks ago, we saw the company's Q1 results where they downgraded their guidance on LNG production due to cyclones off the coast of Australia. So the significance of an LNG demand outlook that sits 21% above STEPS, we think raises some serious questions that investors should rightly be concerned by and deserve answers from the company that have not yet been forthcoming. Over to the next slide, and what we're looking at here is a historical, what we've done here is a historical analysis that looks at how Shell's LNG forecast has changed over the past few years. And as Nick alluded to, we haven't seen the degree of responsiveness to some of the dramatic changes that we've seen in global energy markets that we might expect from this company. So what we've done here in this chart is show the difference between the company's 2020 assumptions and its 2024-2025 assumptions, and we compare that to the assumptions of the IEA for those same periods going forward. And what we can see here is that the IEA has decreased its demand assumptions for 2035 and 2040 quite significantly over this time period, whereas we see this unresponsiveness from Shell's LNG demand projections. They haven't materially changed over that period of time. And what is the IEA responding to here that Shell isn't? Well, one of those sort of major changes and growing trends is the decreasing cost of renewables, and Nick will speak to that a bit more in a few slides' time. And the other point here is that we saw significant medium and long-term demand destruction coming out of the very markets in emerging Asia that we know the company is targeting. And we saw price spikes in those countries as a result of the Russian invasion of Ukraine that resulted in widespread energy insecurity, blackouts, and that contributed in many of these countries to a degree of social unrest. And that has created a political backlash, which has meant that these countries have made long and medium-term policy decisions to move away from reliance on an imported and structurally expensive fuel like LNG. And we've got a few good examples of this that we can see coming out of the very countries that the company is targeting. So Vietnam's Power Development Plan for 2021, if you look at their 2023 plan as compared to 2021, they've downgraded their power from LNG expectations by about 50%. Pakistan imported 22 gigawatts of solar capacity just last year, which is about 44% of their overall grid capacity. So we're already seeing these policy changes that are starting to crowd out the role of gas in power systems in the markets that Shell is targeting as part of its LNG growth strategy. And it's just notable that the company's LNG forecast has not been responsive to these changes. And this is another question that we think is a legitimate one that is likely shared by many investors. And that's at the heart of the disclosures that we're trying to seek from the company here. So over to the next slide, and we'll start here to sort of dig into the actual LNG outlook. And I suppose here it's useful just to pause and bring together some of the strands of what we've already spoken to. So we know that the company has this ambitious LNG growth strategy that's really kind of their flagship strategy at the moment. They've taken this outlier status in terms of their uncontracted position, and that leads to a significant degree of financial exposure, as Nick has explained. And they have this bullish demand forecast that sits 21% above steps, which I've just spoken to. So bringing these three pieces together, we think that that imposes a high burden of proof on the company to be reassuring investors that the financial risks inherent in their LNG strategy are well justified and are underpinned by really solid evidence-based demand assumptions. And so that's what we look to when we look to the LNG Outlook to say, has the company sort of delivered on this? Has it executed its burden of proof and reassured investors to the extent that we would expect to see? And the short answer is no. So this is just a sort of snapshot diagnostic of some of our concerns with the LNG Outlook that the company produced in February. And there's a lot more information about this in the research, but to sort of give you the top lines, on the left side of the screen here, we're seeing the company's, this is coming from the LNG Outlook. They define the different sectors where they see natural gas demand growth coming from out to 2040. And notably, they spend quite a lot of time in the LNG Outlook talking about the transport sector and describing applications for LNG in the marine and trucking sectors. That's the slimmest of all of these segments. And then there is almost nothing in the LNG Outlook that explains where demand will be coming from the power and industrial sectors in particular, which we think is a really glaring omission. On the right side of the screen, what you can see is a list of what the company is describing as demand drivers. And again, it lists out these demand drivers where it sees growth coming from for LNG, and it fails to really provide evidence to substantiate how these demand drivers are going to materialize specifically into increased demand for LNG in the markets that the company is targeting. And so just to take two examples here, the example of data centers and AI, and then Asian economic growth. So to take the first one, the data center AI story is an interesting one. It seems to have been kind of increasingly embedded in the company's narrative around LNG demand. And we see it mentioned in the top of the LNG Outlook. We see it referenced heavily in the CEO's talking points at the Capital Markets Day. It was sort of the headline of the media release that accompanied the LNG Outlook rather. And there's simply nothing in the remainder of the document that substantiates how data centers and AI are going to turn into increased LNG demand. So again, a really notable lack of evidence around this as a demand driver for LNG. Asian economic growth is another big part of the LNG story for Shell. And here we see a few kind of patchy examples of evidence to suggest that there will be a relationship between economic growth in South and Southeast Asia and demand for LNG. So the outlook looks at graphs of Asian regasification capacity, for example. We think that this is a fairly poor proxy for demand based on the fact that there is significant fluctuation in utility rates for this type of infrastructure. There's also a handful of other snapshots that look at things like residential gas connections in China and India, changes in Chinese gas consumption for the last 12 months. But what we're really not seeing is a sort of joined up, coherent narrative that will explain how the company sees LNG as a structurally expensive fuel with a tarnished reputation in these markets, being capable of displacing renewables in the very sort of price-sensitive emerging markets that they are targeting. And so our sort of overall diagnostic then of the LNG outlook is that it really doesn't fit the bill in terms of reassuring investors. It provides a sort of handful of flimsy factual snapshots that looks at sort of shorter term trends and developments, lacking this sort of overarching evidence-based narrative as to how these trends are going to translate into growth in LNG demand, and reassuring investors that the financial risks baked into their strategy are really well justified and grounded in strong assumptions. Let me hand back to you now, Nick.
Thank you. Another part of the company's narrative that we have observed is the role that contracting is playing in terms of being a signal of market confidence or long-term demand for LNG. And so the company does disclose sort of the presence of long-term contracts, but it doesn't disclose the breakdown by the organizations that are signing those contracts. And so that's the analysis that we're doing here on this page. And you can see on the left-hand side, the increasing presence of portfolio players through the 2030s and into the 2040s. Portfolio players, essentially oil and gas companies who are looking to buy the LNG and then sell it on to other users. They use a very small amount in ships, where LNG powered ships, but for the most part, they're not users of that LNG. And so you can see through the 24 through to the 2040s, the presence of portfolio players increases up to around 50%. And so we question whether looking at the presence of these contracts as a whole is really a sign of the confidence in LNG markets over the long term. And I already spoke about the hesitancy around end users actually signing those longer term contracts and the caution with signing them, particularly in the next few years, as prices are going to fall over that time period. And then we took a sort of deeper look into sort of who are the organizations that are signing these contracts and who are the biggest players in terms of signing contracts beyond 2031 through to 2050. And we see the top of that pile is Shell. Obviously, sort of they're the biggest player here, the largest independent trader of LNG and around 11% of the LNG market. And this really sort of to come back to the resolution and the rationale behind the resolution, the future of LNG markets are much more material for Shell than the future of oil markets. And the impact that they'll have on Shell compared to other oil and gas companies will be much, much more significant. And you can see Shell here, see a few other oil and gas companies, Total, ConocoPhillips, BP, and others as well, signing these longer term contracts. And then as it relates to some of these smaller companies that are actually the end users, there are a mixture of other oil and gas companies, but mainly focused on the petrochemical side of things, also signing these contracts. But really sort of there is this big presence of oil and gas companies, and we sort of question whether there is this confidence in LNG over the longer term that Shell seems to be building their strategy around. on the final slide, we look, this is sort of referring back to the levelized cost of electricity analysis that we did sort of that I spoke about earlier in the presentation. Here we look at the LCOEs for China and India, and there has been sort of this notable pivot in the company's LNG outlook between 2024 and 2025, a shift from focusing on smaller emerging market countries like Malaysia, like the Philippines, like Vietnam, to a larger presence of China and India in the narrative around that LNG outlook. And so that's sort of the reason that we focused here. We have done this analysis on those other countries. But you can see here sort of the cost of powering an LNG to combined cycle turbine asset in India is about 4 times the price of building new solar. And then when you take into account storage costs, the cost of building new storage and solar is about half the cost of operating a CCGT plant in India as well. It's a similar story for China, slightly less dramatic, I would say, about a third of the cost for building new solar compared to running a CCGT plant. And we're seeing the impacts happening in these countries already. Declining demand for LNG in the first quarter from China. You look at combined cycle gas turbine utilization rates in India, and they're around 8%, which is really shocking and shows that sort of even if these assets are in existence and even if these assets are in place within the grid infrastructure, they're running a very small amount at a time when you have alternative, cheaper options available to you. And so sort of there is this sort of narrative from the company around sort of what role will LNG play in this power system, but we think sort of that role will be very small and doesn't justify the very high demand forecast that Shell is predicting within these countries. And when you look at data from the IEA and other forecasters as well, the role that gas plays in power systems is very limited. Looking at some other end-use sectors, in India, we have seen LNG demand growth, and in China in the trucking sector, and also in the fertilizer industry. The trucking sector is interesting for 2 reasons. One is there's been some recent policy action, much of which is related to lobbying that Shell is participating in within these countries, that is supporting the use of LNG in India. But then there's been recent commentary from Wood Mackenzie, of which Shell bases a lot of its demand forecast off of, saying that sort of LNG is only competitive within trucking through to 2030, and after that, battery electric vehicles are going to be more cost effective than LNG powered trucks. The other industry in India is the fertilizer industry, and India has a goal of self-sufficiency in the food industry, and that again is a sort of heavily subsidized industry, and we don't see any LNG demand growth really across any other sectors in India, except where there's that policy support. And so again, building a strategy from Shell's perspective that is predicated on serious subsidization and policy support does raise risks for investors and does raise questions around that future demand growth in other sectors outside of the power sector as well.
Thanks very much, Nick. So that brings us to the end of the technical presentation, and we hope that what we've presented has been helpful in informing your vote at the upcoming AGM next month. And we hope it also illustrates that there is this need for enhanced transparency from the company of the type that we're seeking in the resolution, and the fact that the disclosures that the company's made to date really do make it difficult for investors to fully assess the extent of the material financial risks inherent in its LNG strategy and its demand outlook, and the degree of incongruence between its LNG growth ambitions and its climate commitments. We've got a tiny bit of time left for questions, and I can see that we have one from Maeve O'Connor. Thanks for the question, Maeve, and it's relating to assertions from Shell in the notice of meeting that the special resolution is against good governance, and what our response is to that. And so I suppose I can get us underway, and maybe Nick, please feel free to come in. Our position on this is that the special resolution is the appropriate vehicle to be using. Well, I suppose let me take a step back and break down the 2 sort of bases for that argument that the company is putting forward is the choice of use of a special resolution, and then an assertion that there hasn't been sufficient engagement from the co-filers ahead of filing the resolution. Those are the sort of two strands of the argument the company's making. To take them one by one, a special resolution is based on the legal advice that we've obtained, the only way in which shareholders can sort of compel the company to make enhanced disclosures, and that's on the basis of the Companies Act and Shell's Articles of Association, which expressly provide reserve powers to shareholders that can only be exercised through the use of a special resolution. Our understanding is that the company in some engagements has been saying that special resolutions are reserved only for specific and sort of sensitive and rare types of corporate actions. Our understanding is that the Companies Act certainly does require a special resolution to be used in this case, but it doesn't then exclude that use in other conditions. And based on our reading of the articles, this is appropriate. We'd also say that, when we did file, there was a verification process that the company carried out, and they responded to us in February to say, we've received this, we've verified it, it is a valid filing. So it's kind of interesting and surprising to see this position being taken. I suppose on the engagement point, as you heard from Vaish at the top of the webinar, there has been extensive engagement with the company in the lead up to filing by Brunel and ACCR and PERC, who is the advisor to the underlying funds who co-filed Merseyside and GMPF. Those two funds have also had direct engagements with the chair. So the idea that we haven't engaged and that represents good governance is another sort of confounding one to be hearing from the company. I can see a follow-up question on engagement and how many times we've engaged with Shell and how many times we engaged with Shell and did each of the co-filers meet the company. I don't have that number on the top of my head. I think we spelled this out in our response to the notice of meeting. And maybe I can just quickly pop that link in the chat. But it was certainly, Nick, if you have that sort of ballpark number off the top of your head, please jump in now.
So, there's been sort of two strands to our engagement. One that's more focused around lobbying, and obviously this 1.4 billion tons of LNG creates a massive incentive for the company to be lobbying for LNG use in more demand sectors. And then one more around the core LNG strategy. And so sort of these two strands have been interlinked. We probably over the past, since Q4 2023, had about 20 engagements with the company across both of these issues, but these are interlinked. And then sort of specifically around the resolution in the past sort of 6 months or so, I'd reckon we've had sort of 5 or 6 different engagements, and our next one is due to be next Monday. So it's been pretty intensive, and that's included, as Sarah mentioned, all of the co-filers and their representatives as well.
Yeah, thank you for that. I might just pause and give Vaish the opportunity if you wanted to come in and comment on this engagement question as well. I know you made some comments. Oh, you're having problems with sound. Okay, no problem at all. Look, in that case, I think we'll close the webinar now, and thank you all very much for your time. Vaish, are you hearing us now? No. Doesn't seem like it. All right. So look, thank you very much for those questions. Thank you for your attendance. If you have follow-up questions that would be useful for you as you prepare your vote at the AGM next month, please don't hesitate to be in touch, and we'll be circulating the recording of this webinar in a few days' time. Thank you all, and enjoy the rest of your afternoon.